Welcome to Commercial Real Estate Pro Network CREPN Radio. Thanks for joining us. My name is J. Darren Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today, my guest is Linying Zou. And 2 years after graduating from Boston College Business School, Linying bought her first multifamily investment. She had a new job, but very soon after she started, she realized that the job was not going to provide her the financial freedom she wanted. So she set out on her own to achieve her goal, and she started Akras Capital. And in just a minute, we're going to speak with Linying about how an immigrant used real estate syndication to achieve the new American dream, reach her financial freedom number, and travel the world. But first, a quick reminder, if you like our show, CREPN Radio, there are a couple of things you can do. You can like, share, and subscribe. And as always, we hope you'll leave a comment. We love to hear from our listeners. Also, if you'd like to see how attractive our guests are, be sure to check out our YouTube channel. And you can find us on YouTube at Commercial Real Estate Pro Network. And also want to encourage you to subscribe there as well. More subscribers, more reach. It's all good. With that, I want to welcome my guest, Linying. Welcome to CREPN Radio.
Thanks for having me.
Well, I am so looking forward to our talk today. But before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Sure. So like you said, I started investing in multifamily 2 years out of school, but I was actually a trader in fixed income for about 10 years. So, I worked for an asset management firm, I worked for an insurance company, and so I kind of went from kind of the Wall Street path into kind of the Main Street path. And so that's like really helping what we're doing right now, because there is a really good segue, from finance into real estate. So, at Akras, my primary role is acquisition. So I do a lot of deal analysis and, underwriting. So, using my background in finance, and that has really helped. So, about 3 years ago, we started Akras Capital, and we focus on both buying small multifamilies for a direct acquisition strategy as well as syndication. So build a portfolio that's allowed us to essentially travel the world and, live our lives on our own terms.
No, sounds pretty good. And I think you said it, but I didn't quite catch it. How long were you at the Wall Street firm doing the asset management? Or you said fixed assets is what you're working in there, right?
Fixed income, so corporate bonds.
Fixed income? Okay.
Yeah, so corporate bonds and government bonds. I was trading those. I was at various firms, but together career total about 10 years. Gotcha.
And when you bought your first multifamily, what was your first multifamily property?
It is still actually. I still own it to this day. So it was a triplex. It was a house hacking strategy. I'm sure your listeners are aware of that strategy, but I, essentially lived in one unit and rented out the two to cover the mortgage. So that was back in 2010. So the market was really supportive of that strategy at the time.
No, it's a beautiful thing when it works. When you have somebody
sure.
else pay your way. So you were in the Wall Street world. I mean, it seems pretty glamorous from the outside. What was it that you recognized being in it that it wasn't going to get you where you wanted to go?
I think it's a couple of things. For one, it's very glamorous, right? You see it on TV all the time. It's a very high-paced career, and you can make a lot of money doing it. But I think the problem is that there was just no greater purpose in that career. You essentially try to make money with money, and there is not enough flexibility or control on what I want to do, that really didn't jive with me very well. So because of that, I mean, don't get me wrong. I love the job itself. It was challenging. Every day was different. I have you have to pitch so many trade ideas, and you have all these ideas come to the door, and you have to vet them. So that was always my favorite part of the job. But it's just really the culture, and I realized that just because I didn't like my job at this company doesn't mean that I'm going to like my job at the next company, because I'm going to face the same issues where, I don't get to live my life on my own terms. And, I have to basically go in and have FaceTime and essentially, listen, have the culture be something that I have no control over.
No, that's pretty big insight, I think, for a lot of people. I think there's kind of an exception, or not an acceptance, is what I was trying to say. Of just that's the way it is, and this is what you do, and you go and you try and do more and earn more and keep earning more, but not necessarily recognizing the quality of life. And unless you have a really rich life outside of that, and that's your primary vehicle. But you think about it, how many hours a day you spend at work, and I'm assuming that Wall Street, you weren't necessarily working just a 40-hour week. At least
Yeah,
from what
I worked on the buy side, so that was a lot. The work-life balance is there, but I still spend about 10 hours a day at work. And it's easy, right? It's easy to get kind of stuck in the comfort because you just do the job, and then, our academic system trains us to, find a good job, get better pay, and, climb the corporate ladder in a sense. And so it's really easy to get stuck in the comfort where you go to work every day, go home, go to the gym, go to your family, and then look forward to the weekend and then dread the Mondays, right? It's so easy to get comfortable. I was at a point where I was really dreading that Monday morning for about 2 years until I managed to leave the company. So that was a really valuable experience to be able to exit and see, there are so many other opportunities out there that can provide me the life that I want to live versus what I was living before.
No, that's good. So you bought your first property. You're still working your Wall Street job.
Mm-hmm.
Was real estate kind of uh, I guess I'm trying to figure out, how did it fit in? Because it sounds like, was that always a goal, or was that just something that happened based on the fact that you were having success house hacking?
I think real estate really is the American dream, right? Like owning property in the States. I'm a first generation immigrant. So it was really buying the first property, it was really a family decision. My parents came here and they never owned real estate and they never owned a house. And, I wasn't in a financial position to be able to do that. So that was like the American dream, the family dream of me owning a real estate property. And then after I bought that property, I managed it myself. And it was until 4 years later, I bought my second property. And I was in the process of buying my third property when I left my job. So that, that threw a wrench in things when you don't have a W-2 income. Or when you're looking to buy residential properties, that's like 4 units and below. So, I put a pause on that. I went travel the world, came back, and then when I started to, started Akras, my business partners, that's when we started investing in real estate full time and started buying other commercial properties.
Gotcha. And you mentioned you bought your second and third property. What were those?
I bought my second property, which is actually my primary residence right now. And then my third one, we're in the process of buying I was in the process of buying an off-market property at the time. But then it kind of fell through in the last minute, and then I left my job, so that just didn't go anywhere.
Gotcha. So you traveled. How long did you give yourself to travel, and where all did you go?
I traveled for 6 months
Okay.
on the road, and my basically backpacked across Europe and Asia. So I was I basically went, to Estonia and UK and Iceland, and then kind of flew back into Russia. So I spent about a month in Russia, 2 weeks in Mongolia, 8 weeks in China, and then South Korea. I was actually in South Korea when the Olympics was happening, and then I went to Japan. So
Wow. Well, there's no substitute for travel. I love kind of the experience and just kind of the education of meeting people in different places and all that. So it's awesome.
yeah, I think traveling really changed my mindset and how I view, what basically happiness is. Because as you travel through these, more kind of developing countries, you get to meet people who are living very happily on very little. So it kind of creates, it kind of quite brings into question, like, why is money so important, right? Why is it making more money, having a bigger house or having a really nice car important when happiness can mean, just something completely different to someone else. So I think that kind of changed my mindset on how I want to pursue that next step in my career. Because when I first started, my idea was always that I'm going to go travel and then come back and find another job, another finance, investment firm, and just continue that career path. And then having that kind of experience, just seeing, meeting people on the road, encountering different cultures, that's when, my business partners and I kind of sat down and said, hey, like, do we really want to go back to the corporate world? Is that really important to us? Is that the end goal? Is that the end all be all? And we decided it wasn't, that we wanted to create freedom for ourselves and, help create that kind of freedom for other people so they can pursue that passion on their own.
Now it sounds like you were what am I trying to say? Coming from that Wall Street culture and just kind of the go fast, more and more, little world travel, and all of a sudden now you've got a different view of maybe what's important. It sounds like.
Mm-hmm.
Once you had that change, I would think it would be kind of hard to go back to Wall Street or just in that kind of thing. I don't know if there's a lot of room for that kind of more of a Zen kind of a mindset, or do you find, were there people in Wall Street you ever saw that had that kind of a view of things?
I think very rarely. I think, people do want, I think most people do know what's important to them, but I think it takes a lot of courage to kind of step outside your comfort zone. And I think when you've been doing the same job for 10, 20, 30 years, it's hard to change into something else because it's scary, right? There's so much uncertainty. You don't know if your skill set applies. So, it's easy to kind of stay with the comfort and stay with what you know. So I don't want to say that people on Wall Street and people in finance don't know, don't understand like what's important to them, or, that, how they value money. But it's just that you can get stuck so easily and it's hard to get out.
Yeah.
And actually, personally, I know so many people like recently that have gotten out and pursued other careers where, they maybe started a restaurant or maybe they started a startup, so you do have that kind of people that leave the industry to pursue something else.
Right. Well, having that experience where you were able to um, untether from that pace and that lifestyle and that culture for an extended amount of time. I mean, 6 months, I think is a good, um, amount of time to actually kind of reset or have the opportunity to adjust. And while you're traveling and seeing all these different things, it's kind of exciting, but at a different pace.
Mm-hmm.
That's got to be great. So you came back, and was it right away that your partners? And you mentioned your partners. How many partners do you have?
I have two other partners.
Okay, and were they also in the same situation, or what was their?
Yeah, so one of my business partners, Christina, we actually worked together in my last company, and so now we've been working together for about 8 years. So she and her husband Charlie, who's our other business partner, were also traveling, and they traveled for 14 months, and we worked together for about 6 weeks during our travels, through Russia and Mongolia. And, we really have a chance to kind of sit down, and we know how well we work with each other. And so the timing just worked that when I came back, they also came back. And then, we had that opportunity to kind of sit down, have a just strategic meeting, I think in July of 2018. And then, we decided to kind of go venture into real estate.
And were they real estate investors as well?
Yeah, so when they were trying on the road, they had a property in Boston, which they were renting out as well. And the rental income from that were enough to, pay for the mortgage and provide for them when they were on the road as well. So.
No, that is definitely the footloose and fancy free kind of, when the worries are taken care of. That's the mortgage is paid and you've got money to live on. That's pretty good.
Exactly. It's a lot cheaper to live overseas too. So, I mean, it depends on the country, but most of the countries, it's a lot cheaper to live there than in the US.
Right, right. So they were basically renting out their home. Did you rent out your home while you were gone as well?
I did. So I had my triplex, which is, always rented. And then I did Airbnb my property for a month or two. Boston is very seasonal on Airbnb. So, in the winter, no one wants to visit the cold, blizzardy, city of Boston. So you don't really get a lot of Airbnb business during the winter. And I was traveling during the winter. So, but I did start using Airbnb as an option to provide more cash flow during that time.
Gotcha. All right. So you and your partners realize that you're of like mind, you work well together, and the decision is made, let's go do real estate.
Mm-hmm.
What was your focus, and how did you go about achieving or acquiring additional properties?
Yeah, so there were definitely many asset classes within real estate. And, we knew from very early on that we want to do multifamily because it is the cyclical of the asset classes. Everyone always needs shelter, right? So it doesn't matter where the economy goes. So we wanted to go into multifamily, and then we kind of decide to pick which market we want to be in. And, we figure Boston, I live in Boston, my business partners live in Boulder, Colorado. So both the markets are extremely expensive and, it doesn't cash flow well. So we picked a market that's familiar to my business partner, Charlie, because he grew up there, which is Spokane, Washington, to kind of dip our feet in a sense. And we started acquiring multifamily there. And we started fairly small. We did our first property, it was a 5-unit, and then we bought a 7-unit, and then we bought an 11-unit. So, and we mostly use like wholesalers to buy these properties. So all of them were off-market listings. And so a lot of the initial efforts went to relationship building and building a team on the ground, because it would be long distance investing. And then eventually we got into syndication, where, we partner with other operators to syndicate deals. And, we did a like 300 unit and then like 111 unit in Fort and Dallas, because that's where our partners have experience in.
Gotcha. So the 5, 7, 11, were those buy and hold, or were you repositioning and selling those, or what were you doing?
So we were using the BRRRR strategy. That was our goal. So the 5, 7, 11, actually we're currently in the process dispositioning them. And we actually sold the 5-unit already, and we're under contract on the 7-unit. And the 11-unit is currently on the market. So we're actually trying to sell those properties and then roll them into a larger asset in a different city. We don't like Spokane anymore. So we're actually going to move into Phoenix, Arizona. So.
Gotcha. And now, so you did the BRRRR strategy with the first 3 properties.
Mm-hmm.
You get some experience. How long between the acquisition, repositioning, refinance, operating before you jumped into syndication?
About a year. So we spent about a year acquiring our own assets, and then we jumped into syndication.
All right. And the 300 units, I mean, that seems like a pretty big jump from, you know, 20, what do we got? 23 units, 3 properties to a 300 unit deal. Can you tell us a little bit about the 300 unit property?
Yeah, so it is a syndication deal. So we are a small GP in the deal, and it is our first syndication deal. So we actually we met some partners at a conference that we attended, and we established a relationship there where they brought us into the deal. So that was really a Class B plus property down in Orlando, Florida. It's actually really nice. I visited myself, and we visit all of our properties when we do our due diligence. But it's essentially more cash flow play, and we still have equity stake in it right to this day. So it was definitely a learning experience for the first one, and we're glad to have the experienced operators there with us that we can kind of learn from. And so it's been a very great experience. Yeah.
No, I appreciate you sharing that, because I think that a lot of times people recognize the smaller properties as something they can take on by themselves.
Mm-hmm.
They recognize the syndication as a model for taking down a larger property, but don't always recognize how they can fit into the syndication model, thinking that you have to be the general partner or you can go in passively. Can you speak a little bit how you came? I mean, you mentioned that you met them at a conference, but just coming in as a general partner, what were your responsibilities?
So the responsibilities will vary depending on the deal itself. So, for example, there are you can come in and be kind of investor relations and capital raise, or you can come in and help with asset management. So for some of the syndication properties, we do help out on the asset management side, on the leasing side, and on the marketing side. And there's like interior renovations and things like that. So there are like various communities we can get involved in. So as a GP, that's really your role, right? Like the main GP brings the deal, and then other GPs come in to bring both the capital and experience and resources to get the deal done. And there could be someone there too that signs off on the loan, right? Because for an agency loan, you do need to have the amount of net worth that's enough to guarantee. It's not a recourse loan, but you still have to provide your kind of sign off on it. So that's really the role of the GP. I mean, it is a lot of work. I mean, it is a business. For a syndication deal, you're essentially running a business. So it's really important to partner with other people who have kind of business mindset. And as an LP, I mean, I think for a lot of new investors that want to get into real estate syndication, LP is a great route to go, because, you get to understand how the deal works, but you're completely passive. So you don't really take on any responsibility, but you can learn as much as you want to learn, because all the GPs are essentially very open and transparent. And then, you can take that experience, and maybe if you want to be on GP side for the next deal, then you have a way to get in. And as an LP, you get your cash flow, which is the best part, right? The GPs typically don't really get cash flow during the time of the deal. They get paid on acquisition fee and then at disposition. So as an LP, you're passive and you just get your monthly quarterly distributions.
Right. And where are you in the cycle of the 300 unit property?
We're in year 2. So, it's generally a 5-year hold. So we're less than halfway through.
Right.
But a lot of times, it really depends on, because we're always continuously kind of revaluing where the property is today and, what the value can be. So it's not unusual to exit the property or exit a deal earlier, and as long as we can hit that IRR threshold for the investors.
Right. What about the 111 unit property? Where's that? And tell us a little bit about that.
Oh, it's in Dallas. So that's a more workforce housing. So compared to the first deal, it is different. And this deal has, it's 111 units. It's more Class C asset in a sense. And we're, in the middle of there were some issues in the beginning due to tornadoes. There were like 11 tornadoes that touched in Dallas a month after we closed the deal. And so there was a whole insurance claims process that happened. We were in the path of the tornado, but obviously there were some damages. So that kind of pushed off the kind of renovation plan a little bit. And then you have COVID happen. So with the eviction moratorium, things like that. So it took a little bit more time for this property to get up to where we want it to be. And so it's still in process of getting there, but it's making good headway now.
In the 111 property, are you on the general side or the limited, or how are you?
We're on the GP side, and we're on various committees to help with the asset management as well.
All right. And on each of these, how many people are there on the GP side of the?
It depends. I think for a larger property, because the capital raise is much greater, there can be more groups involved. But for the smaller deals, it could just be like 4 to 5 GP groups. So it really depends on what resources are needed to come in to help the deal close successfully.
Right. And what are you guys looking to possibly be the general or to be a sponsor yourself going forward?
Oh yeah, I mean, that's really what we've been doing this whole year, is that we've been looking to lead our own syndication deal. So we're actually in the best and final round on the deal today. So I have to go submit a best and final offer on a property in Arizona by tomorrow. So that's what I'm going to do after this call.
Oh, that's exciting.
Yeah.
How large of a property is that?
It's a 63 unit in Arizona. So it's about an $8 million deal.
No, that's great. That's great. And
Yeah.
you guys are the sponsor on that? You found the deal?
Yeah, we'll be the lead sponsor on it if we get word of the deal. So, but it's still early. There are 5 other groups in the best and final round. It's very competitive. I'm sure but it's just very competitive nowadays. Inventory is very slim, and there's still a lot of buyers out there despite COVID. So hopefully, fingers crossed.
Yeah, I wish you well with that. I know, the whole COVID real estate Rubik's Cube has been kind of an ongoing question. People have been, or I think a lot of the conversations that I've listened to or been a part of have tried to match up the past market cycle to this market. Mm-hmm. And I think for a lot of reasons, there is no way to compare the two based on just the different factors that fed into this situation. In the prior crash, the 07, 08, clearly there was a lot of loose financial dealings as far as lending was pretty loose and that. And now you've got the economy was running pretty good up until the virus hit. You have much more conservative lending, and kind of what I'm hearing from people that are working on deals is that the requirements to close are a little bit more stringent with the banks wanting you to have higher reserves, et cetera. Mm-hmm. But the market seems to be holding up. I mean, rents are still being, for the most part, paid, collected. So, especially with multifamily, it seems like it's still a pretty strong market, and I think people keep looking for that sign that the thing's going to take a dip, but I don't know. I'm not seeing it. I'm not, I think there've been like certain markets or certain things like right after it happened, but as long as the stimulus checks and the economy keeps improving, I think things look pretty good. So.
Yeah, I think it depends, right? I mean, when COVID first happened, everyone was expecting there to be higher delinquencies and lower collections. And then, you have the massive stimulus package that came in from the government that really helped. And that, just the expanded unemployment benefit just ended, at the end of July. So it's kind of too early to tell what's really going to happen, especially if there's no stimulus that comes again. So that is like one of our greatest concerns, right? Is that there's an extended kind of extended recession and extended high unemployment. And that's really going to affect collections. And in a lot of cities, the eviction moratorium is still in place. So you can't really evict your tenants if they're not paying. So I think, if this does go on for a while, you might see the dip that you were looking for because, some properties, some deals are going to be under stress. Due to the low collections. If they can't meet the debt service coverage ratio, then they're in trouble. But that's not going to be in the immediate term, right? There's always some kind of cushion or reserve in place. But I think we just have to be really cautious about, how we're underwriting future deals and whether or not we're using conservative assumptions, because at the end of the day, no one knows where this COVID is going to go. And you can only make as conservative as you can to kind of understand and kind of, how to say it, offset the concerns, right?
Right. No, yeah, I'm kind of curious. You mentioned two things there. One is you have to be conservative with your underwriting based on all the unknowns, but then you mentioned it's very competitive.
Mm-hmm.
Are you finding that um, the competition is equally conservative, or are there some that are willing to throw caution in the wind? And I guess you're going to find out later today or further on. But do you have any kind of sense in talking with brokers what you're?
I think, we are trying. It's a delicate balance. Like you have to walk a delicate line, right? If you're too conservative, you're never going to win any deals. But at the same time, we definitely encounter deals where we're like, wait, how does this even make sense? It makes like no sense to us. Like how this was underwritten to justify this price. So there are definitely groups out there that's still doing deals and using, aggressive assumptions. I think it just, the investors just to be cautious that they trust the GP and they trust the underwriting, because it's so easy to kind of just go in and say, hey, the numbers look really good. I want to invest in this deal without understanding all the assumptions that went into it. Because everything's, the pro forma is just, whatever the GP comes up with, right? You can assume a 20% rent growth if you want. And, that's going to make any deal work. But you just have to make sure that your GPs know what they're doing and how they're underwriting. And they have that kind of, financial background to understand, what's going on and how to offset some of these risks.
Let me ask you, with syndication, I mean, one of the primary goals or the challenges you face is raising capital. How have you gone about building your investor network or creating a pool of investors?
So we have various strategies. So I'm on the acquisition side. My business partner, Charlie, he's focused on the capital raising. So we actually have various strategies targeting different tiers of investors. So, obviously there are tier one investors where, basically our friends and family and our close networks. And then there are tier two, and then tier three are basically investors that we see from, podcasts or from, just web content. So we have, through different channels, we build an investor base, and then we provide a lot of educational content through our, monthly newsletter, through our white papers, through our website. We have, a lot of articles on the website that's educational. And, we are essentially using both pull and push marketing in a sense, to generate that kind of investor interest. I think it's really important to continue to talk to people too and just educate them that syndication is an option, because I personally didn't know syndication existed 10 years ago. And I probably would have gone into it a lot earlier if I had known that this is an opportunity. Even when I was working a second job, right, I could have just been an LP, right, on the deal. So I think, the fact that not a lot of people knew that this opportunity existed is something that we work really hard to bring to others. It's just this awareness that, there's syndication if you don't want to be a landlord and you want a cash flow and somewhere to kind of put your money that's away from stocks and bonds.
Right. No, I think there is a lack of recognition, almost by design. I think the little bit of the history that I've come to understand about the stock market and the 401ks and the structure of that was more about stocks and bonds, kind of thing. And I think people get trained in that, and that's kind of, you go to work, your 401k, and you just kind of pick your fund, and the ability to have it be liquid, is something. I know I've talked to some people, and they're like, well, but you can't get your money out. I say, well, but it's, it is a longer term investment. But the returns, I mean, the risk, there is risk, but the potential returns are fairly, I guess it all depends on the operator, but a little bit more of you can see the path to the exit. And I say it as, you got to be careful what you say, because it's always case by case, and only at the end will you really know. But no, it's good. So you've got your property. You're in Arizona, that you're in last and final, or best and final. And what do you feel like is the Arizona market you want to really plant a flag and build, or is it still just find the best asset wherever the best opportunity is?
Yeah, I mean, we do have a focus in Arizona right now. I mean, our key strategies has always been inland growth cities, right? Like secondary cities that's getting the population and permanent growth from the coastal cities due to the cost of living, better quality of life, et cetera, et cetera. So we do, so we actually went through a market criteria exercise, and, Phoenix, Arizona does fit most of the criteria that we come up with. And so, yeah, so we do want to have a focus in Arizona at this time. We're really not looking, unless like our partners bring us in as like a co-GP on a deal in another market, we won't look at any other markets at this time.
Got it. And are you still in regular contact with the people you met at these conferences? Do you look to them when you're trying to raise capital for your own sponsored deals?
Yeah, absolutely. I mean, it's important. I mean, in real estate or anything really, it's important to have partnerships, right? Because they complement you. And, for partners that we found that at these conferences or meetups, or, people that we know, we actually, have like regular scheduled calls with them to build that relationship. Because we think of partnerships as a long-term thing. Like we never just go to like get to know someone at a conference, and then 6 months later we have a deal and say, hey, do you want to come in on this deal with us? No, we want to know you. We want to know if you're ethically aligned, if you treat your investors like we do. How is your underwriting? Like, how do you look at these business plans? So I want to make sure that all of our ethos are aligned first. And then, we start to say, hey, do you want to partner on a deeper level? So all of our relationship is maintained through years. And that's what we want to do going forward too, is just have these long-term partnerships that we can, tap into for resources, or help them if they need help. And that way we can kind of grow together.
No, that makes a lot of sense. Makes a lot of sense.
Mm-hmm.
Hey, Linying, if we could, I'd like to shift gears here for a second.
Sure.
By day, I'm an insurance broker, and I work with clients to assess risk and determine what to do with the risk. And there are 3 different strategies we typically consider. The first is we look to see if we can avoid the risk. If that's not an option, we look to see if we can minimize the risk. And when neither the avoid nor minimize strategies will work, we look to see if we can transfer the risk. And that's what an insurance policy is. And I like to ask my guest if they can take a look at their situation and or their investors or client situation and identify what they consider to be the biggest risk. And for clarity, I'm not necessarily looking for an insurance related answer,
Mm-hmm.
but if you're willing, I'd like to ask you, Linying Zou. I'm sorry, Linying Zou, is that right?
So,
Zou.
yeah.
Linying Zou. What is the biggest risk?
Well, as owner-operator of real estate right now, the biggest risk is a prolonged recession and sustained high unemployment. And if there are no more government stimulus, because that will really affect our collection and its collection numbers. So that is really the biggest risk.
Yeah, I think there's a lot of people that are, like we said, kind of waiting to see what happens here. It does seem, well, I don't know, the election and all that stuff going on right now. I would hope that there's some sort of an effort to keep things afloat rather than just let it crash. But I guess time will tell.
Mm-hmm.
Linying, where can the listeners go if they would like to learn more or connect with you?
So yeah, your listeners can come visit our website at www.akrascapital.com, AKRAS capital.com. And or you can just send me an email at LZOU at akrascapital.com as well. So we have a lot of educational content on our website, and we have a monthly newsletter, and we have a white paper called The New Roadmap to Financial Freedom. If anyone want to download it, you can find it on our website as well.
Great. Linying, I can't say thanks enough for taking the time to talk today. I've enjoyed our talk and learned a lot, and I hope we can do it again soon.
Yeah, thank you.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.